Picture this. You wake up one morning and realize your money has been working harder than you. Sounds amazing, right? Well, this isn't just a dream. It's the reality for millions of smart investors who've learned how to make their money work for them. No tricks, no gimmicks, just simple strategies anyone can follow. And today, I'm going to share 3 powerful investment strategies that could completely change your financial future. We're talking about taking control of your money, watching it grow, and building a solid foundation for a brighter financial future. These strategies aren't just for financial pros or billionaires. They're for everyday people, just like you. Whether you're saving for retirement, building wealth, or simply trying to get ahead, these methods can work for you. And trust me, they're easier than you think. Let's get started. Let's kick things off with the most beginner-friendly strategy: index investing. This is the perfect way to dip your toes into the world of investing without feeling overwhelmed. But first, let me ask you, have you ever tried picking individual stocks only to feel like you're gambling? You spend hours researching companies, reading financial reports, and trying to decipher market trends, only to see your chosen stocks plummet the moment you hit the buy button. It's enough to make you want to swear off investing altogether. But here's the thing, you don't have to be a Wall Street whiz kid to succeed in the stock market. In fact, trying to outsmart the market by picking individual stocks is often a recipe for disappointment. And that's where index funds come in. Think of an index fund like a basket of stocks that tracks a specific market index, like the S&P 500. Instead of trying to pick the winning stocks yourself, you're essentially investing in the entire market with a single purchase. This diversification spreads your risk across hundreds of companies, protecting you from the volatility of individual stocks. It's like having a team of expert stock pickers working for you, but at a fraction of the cost. One of the biggest advantages of index funds is their low fees. Actively managed funds, where a fund manager handpicks stocks, often charge high fees that can eat into your returns. Index funds, on the other hand, are passively managed, meaning they simply track a specific index, resulting in significantly lower fees. And lower fees mean more money in your pocket. Because index funds track the overall market, they tend to provide steady, long-term growth. While they may not experience the explosive growth of some individual stocks, they're also less likely to suffer dramatic losses. This makes index investing a fantastic option for long-term goals like retirement, where slow and steady wins the race. Another advantage of index funds is their simplicity. You don't need to be a financial expert to understand them. Simply choose an index fund that aligns with your investment goals, set up a regular investment plan, and let your money work for you. It's that easy. Many brokerage accounts offer fractional shares, allowing you to invest in index funds with even small amounts of money. This means you can start building a diversified portfolio even if you don't have thousands of dollars to invest up front. Index investing isn't about getting rich quick. It's about building wealth gradually and steadily over time. It's a strategy that requires patience and discipline, but the rewards can be substantial. So, if you're looking for a simple, low-cost, and effective way to invest your money, look no further than index funds. They're the perfect foundation for any well-rounded investment portfolio. Imagine getting paid just for holding on to your investments. Sounds too good to be true? Well, it's not. That's exactly what dividend investing does for you. It's one of the easiest and most rewarding ways to build wealth over time. But what exactly are dividends, and how do they work? Dividends are a portion of a company's profits distributed to shareholders. When you invest in dividend-paying stocks, you become a part owner and are entitled to a share of its earnings. Think of it like owning a rental property. You receive regular rental income, and with dividend stocks, you receive regular dividend payments. These payments are typically made quarterly, although some companies pay monthly or annually. Not all companies pay dividends. Some reinvest profits to fuel growth, while others may not be profitable enough to distribute dividends. Dividend-paying companies are typically well-established, profitable businesses with a history of sharing profits. They tend to be in mature industries with stable earnings, making them attractive for consistent income. One of the most appealing aspects of dividend investing is the power of compounding. Reinvesting dividends buys more shares, generating even more dividends in the future. It's a virtuous cycle that can supercharge your returns over the long run. Dividend investing isn't just about generating passive income. It can also mitigate risk during market downturns. When the market dips, stock prices fall, but dividend payments from solid companies often remain stable. These consistent payments provide a cushion, reducing volatility and giving peace of mind. To get started, research companies with a long history of dividend payments and strong profitability. ETFs specializing in dividend-paying stocks make it easy to diversify your portfolio. Remember, dividend investing is a long-term strategy. Identify companies with a solid track record and a commitment to sharing profits. It requires patience, discipline, and a willingness to hold on to your investments for the long haul. If you're ready to build a portfolio that generates passive income and helps achieve financial goals, dividend investing might be perfect for you. Chapter 3. Value Investing. Unearth hidden gems and unlock market-beating returns. Imagine walking into a store and finding a high-quality item on clearance for 50% off. Feels great, doesn't it? That's exactly what value investing is. Buying top-quality stocks that are temporarily undervalued by the market. It's like finding hidden treasures in the stock market bargain bin, and it's a strategy that has been championed by some of the most successful investors of all time. But what exactly makes a stock undervalued? Value investors believe that a company's stock price doesn't always reflect its true intrinsic value. Sometimes, due to market sentiment, short-term news, or other external factors, a company's stock price can be driven down significantly below what it's actually worth. This creates an opportunity for savvy investors to swoop in and purchase these undervalued stocks at a discount, with the potential for significant gains when the market eventually recognizes their true value. Think of it like buying a beautiful house in a great neighborhood that's temporarily on sale because the previous owner needed to sell quickly. The house itself is still fantastic, but external circumstances have created an opportunity for you to buy it at a bargain price. Value investors are like real estate detectives, carefully analyzing a company's financials, management team, competitive landscape, and future prospects to determine its intrinsic value. They look for companies with strong fundamentals, a history of profitability, and a clear path to future growth, but whose stock prices have been unfairly beaten down by the market. Once they've identified these undervalued gems, value investors patiently wait for the market to correct itself and recognize the true worth of these companies. This can take time, sometimes months, sometimes years, but value investors are known for their patience and discipline. They understand that the market is not always rational in the short term, but they believe that in the long run, quality companies with strong fundamentals will eventually be rewarded. Value investing is not for the faint of heart. It requires a deep understanding of financial statements, a keen eye for detail, and a willingness to go against the grain. When the market is euphoric and everyone is chasing the latest hot stocks, value investors often find themselves sitting on the sidelines, patiently waiting for opportunities to arise. And when the market crashes and fear takes hold, value investors see it as a chance to buy high-quality companies at bargain prices. It's a contrarian approach that requires a strong stomach and a long-term perspective, but the potential rewards can be substantial. Value investing is a proven strategy that has stood the test of time. It's not about timing the market or chasing quick profits. It's about identifying undervalued companies with strong fundamentals and holding on to them for the long haul. If you're looking for a strategy that has the potential to generate market-beating returns while mitigating risk, value investing might be the perfect approach for you. So now you've learned about index investing, dividend investing, and value investing. But here's the thing, you don't have to choose just one. These strategies can complement each other to create a balanced, diversified portfolio. For example, use index investing as the foundation of your portfolio for long-term growth. Add dividend stocks to generate passive income. Sprinkle in some value stocks for higher potential returns. Here's the bottom line, investing doesn't have to be complicated. The most important thing is to start. The sooner you begin, the more time your money has to grow. So, which of these strategies will you try first? Or maybe you've already started investing. Let me know in the comments below. And if you found this video helpful, hit that like button and subscribe for more practical tips to grow your wealth. Remember, it's not about timing the market, it's about time in the market. Thanks for watching, and I'll see you in the next video.